My name is Matt Leising. I'm a reporter at Bloomberg News, and I'm really excited to have the SEC's crypto czar, Valerie Szczepanik. Sorry.
That's okay.
She's the senior advisor for digital assets and innovation, and we're going to have just a sort of free-flowing conversation about securities tokens and some issues that are in the market today.
Great.
So can you tell us a little bit about what you do, Valerie?
Sure, and it's great to be here. Before I start, I have the kind of, I have a really hard job at the SEC, but it's also one of the best jobs. I have to balance innovation and new technologies in the financial industry with investor protection and market integrity. Not always an easy job, but it really is very rewarding. And if I want to keep it, I have to give my disclaimer, which is essentially that the views I have to express here are my own and not necessarily those of anyone I work with at the Commission. That said, it's really great to be here and have all this enthusiasm for distributed systems all in one roof. But what I do at the SEC is I recently started up the FinHub, which is our SEC's strategic hub for innovation and financial technology that was stood up in October of 2018. And really it was a way to bring together a number of different efforts across the agency to study technology and how it impacts the financial industry, not only in the blockchain or distributed ledger technology space, but also robo-advising, marketplace online lending, peer-to-peer lending, that kind of thing, machine learning, artificial intelligence. And so a lot of different areas where there was a lot of work being done across the agency, we wanted to consolidate in one place. Part of the effort really is to provide not only a platform to broadcast all the work that the SEC's been doing in these areas and to give the public one place to come, to have a warehouse of information and resources, but also to be a little bit of a hearing aid for the Commission staff so that we can meet with people on a regular basis. Our doors are open for people who want to have meetings with the staff, come in and discuss their projects with us, talk about what they're doing. We can give a little bit of guidance in terms of this is how our rules and regulations work. This is areas where you might want to consider this rule or this regulation and how what you're doing might be impacted.
That's one thing I wanted to pick up on.
Sure.
Was because for those of you in the room who don't know, the SEC has not been in the business of giving informal regulatory advice. You're there to enforce the securities laws of the United States. So this is a pretty big change for you guys. Can you tell us a little bit about why you decided to do this and how it's going and how you think you can improve it?
Sure. It's really a way of being nimble. It's hard for an agency to keep up with technology, especially with the rapid growth in terms of a convergence of a number of different technologies that we have now, including cloud computing, artificial intelligence, blockchain, mobile devices, and digital natives coming together. I mean, all this is moving very rapidly. In terms of if you're technology oriented, in terms of your world, these things, you're anxious to get these things out there and to market and to use them in ways that are beneficial. But from a regulatory standpoint, we don't move so fast because we have to look at the impact of the emergence of technologies across the board. And there's many different areas that we have to look at in terms of investor protection and market integrity that you may not necessarily have at the front of your mind. So things tend to move a little less quickly in the regulatory space. And in order to address that mismatch, we wanted to put together a platform where we could be more agile, where we could bring the expertise of the agency all together in one place and kind of leverage what we have in terms of being able to respond and react to what's going on in the market. That said, I think we get a lot of benefit from our interaction with the public and people in the industry because we're learning things as they're happening. So the engagement has been really critical to us being better regulators.
So it's a case of come in early rather than get that enforcement letter down the line?
Absolutely. Yeah, we encourage people to come in. If they have an idea or a project, we want you to, encourage you to come in before you kind of get started on it so that we can kind of talk through what our concerns might be and where the regulatory guideposts might be. And that way you're avoiding not only potential regulatory exposure from us, from other regulators, but also from, if you're setting up a company, it might be shareholder liability. There might be liability for transactions that were unlawfully done in the private realm as well.
So do you have a red phone on your desk that goes right to enforcement? Like if I come in, should I be scared?
You know, I came from enforcement, so I understand how enforcement works. And I think in this area, we've been very balanced. We've tried to take an approach where we're going after cases where it's not, you know, it's not a close case. We've brought cases spanning back to 2013 in the virtual currency area and digital asset area where virtual currencies were being used like Bitcoin and Litecoin in connection with Ponzi schemes or other fraudulent schemes. After the ICO craze, we brought a number of fraudulent ICO cases, but we've brought cases and we've tried to be very deliberate and measured in our approach. So there are a number of cases where maybe it was a regulatory case with no fraud, but maybe we brought a case where there was no penalty. We do want to kind of send messages, and that's, as Kevin was saying, cases can do that really well. But again, we don't want to regulate by enforcement. We want to be clear, and we think we've been clear, starting with the Dow report and a number of statements that we've put out that are available on our FinHub site.
One of those statements was a speech your boss, Bill Hinman, gave last year. He got a lot of attention for sort of drawing a distinction between if a token begins as a security but then becomes sufficiently decentralized, maybe it's no longer a security. How do you feel about that now? What do you think the market response to that was? And is that, how does that fit into the Howey Test and all the other things that you look at?
Okay. So Bill Hinman's speech, and I'm not going to speak for him, but I think I have a good insight as to what he was trying to get at. It was not a new test. It's not the Bill Hinman decentralization test. It's really, Director Hinman was explaining the Howey Test and a very kind of closely related other case called Gary Plastic. So the name of the speech is When Howey Met Gary Plastic, and it really is about the point to make about how something that can be something that's not a security can be offered and sold and packaged as something that is a security. So in the Gary Plastic case, you took something that was an asset that's clearly not a security. It was a CD, a certificate for deposit, and the way that it was sold by the entity that was selling it, it was a broker-dealer, packaged it up, promised a certain liquidity, promised a secondary market, promised a certain rate. The promises made around the offer and sale of that asset that was not a security made that entire investment scheme a security. So the point that Director Hinman, I think, was trying to make here is that the manner of offer and sale of something can turn something that may not be a security in one context into a security in another context. So when you talk about the concept of morphing, I think that's kind of one way of looking at it, but it's not the more accurate way to look at it is it can be offered and sold under one set of circumstances as a security, and under a different set of circumstances, perhaps at a different point in time, offered and sold as something that no longer constitutes a security. And that's the point he was trying to make. What people latched onto is he did use the term, something was sufficiently decentralized that the application of the federal securities laws would not make sense. And I think what he was referring to, or I believe what he was referring to, is really the efforts of others prong of Howey. It's not a new test. It's are you relying on another party or a set of people or a set of entities to perform kind of essential tasks that you come to rely on? And it really has to do with, does it make sense for the law to impose
right, but what if, so let's say
obligations?
It's working. Let's say that the network of computers and smart contracts in the Ethereum case is working and is sufficiently policing its own, product or whatever. That gets you away from the efforts of others, and it also, I think, one of his main points was that it's helping, or it's like the asymmetry is like you guys are always talking about asymmetry. You don't want to have a retail investor who doesn't know what's going on, and somebody selling them a security, and they're hiding things from them. So if that asymmetry kind of disappears, isn't that a valid way of thinking about that in this new sort of context?
Yeah, that's a key point. So under the registration provisions of the federal securities laws under the 33 Act really has to do with full and fair and complete disclosure. So when you're buying into an enterprise, you want that, the retail investor is a good example, but you want that party that has information asymmetry. They don't have all the information of that centralized party that's going to promise that they're going to undertake efforts to make your investment profitable. You want that purchaser to have all the material information that they need in order to make an informed decision whether to purchase, whether to invest. So that's really what the information asymmetry point is. The disclosure provisions of federal securities laws are meant to level the playing field so that when a purchaser purchases something, they purchase going with their eyes open, full knowledge. The SEC is not a merit-based regulator. It's not going to tell you this is a good investment, this is a bad investment. But if it's an investment, it wants to make sure that you have all the information you need to determine whether or not it's a good or bad investment for you, given your investor profile, given your risk profile, and given what you want to achieve out of this investment. So the information asymmetry point is if you're in an ecosystem where there is a central party that has information that's important to the market, and that information is not disseminated to the other participants in the market, well, then you may have information asymmetry that could be handled under the federal securities laws. If it's a completely distributed, and decentralized can mean many things. It can mean decentralization of mining power, of ownership concentration, of influence. But really, you're looking at the ecosystem as a whole. And if everybody has equal access to the same information, even if some people have to work a little harder to get it, but if everyone has the same equal information access, and it's fair to say that no one really has a leg up, and no one's really relying on anybody else, then you might have a community where the offers and sales of these things are not securities.
Okay. Another aspect of this that interests me is, there's a lot of scam ICOs, but the Ethereum network is sort of built where a coin is going to be used to access the services that are being offered. Mm-hmm. So you have to have the coin to use the software. If that software is popular and the demand for it grows, the demand for that coin is going to grow. That would push up the value. So how are you thinking of, you need that coin to access the service, but then if it's popular, it's going to rise in price.
Sure.
So that seems to be hitting different sides of the Howey Test. Where are you guys on that?
Well, I think you nailed it. In order to pass or fail, however you look at it, the Howey Test, you got to meet all the legs of that Howey Test. So, one, is there an investment of something of value that's usually met? Is it a common enterprise? That's usually met in these cases. Really, the prong that people tend to focus on in these digital asset cases is there a reasonable expectation that you're going to rely on the efforts of others in order to make this profitable? So if you've got an ecosystem where eventually the ecosystem will be built out and people are going to use the digital token to fuel the system or to buy a good and service that's available on the ecosystem, and that system hasn't been built yet, and the software is going to be developed, and the people are going to be recruited, and someone's responsible really for doing that and making the promise to do that, and that's going to build the value of the network over time, then it's probably, it's got the hallmarks of a security.
That's something Bill mentioned in his speech was maybe go a more traditional route of debt or equity, build the thing, and then have it ready to go right away.
That's one way to do it, yeah.
And then, how about, you kind of mentioned this before, you guys don't move very quickly. I don't think that's news to anyone. Do you think you're going to be regulating this through enforcement, or do you know of any plans at the commission level to start writing rules and go that route?
We have a number of tools in our toolbox, and one of them is, guidance. Guidance can always be helpful. Enforcement actions when people have broken the law and there's been some damage, or we have to stop a fraud from ongoing, that's always the option to take. Another one could be these no action letters, exemptive relief or interpretive relief. People want to come to us and they want to ask us for some kind of relief in that regard. We'll certainly consider those, and we issued our first no action letter in this space a couple weeks ago. So guidance is something. Rulemaking is also something that we always consider, but again, that is an even more cumbersome process. There has to be notice and comment. It takes some time to do it, and in an area where you have rapidly evolving technology, sometimes the rulemaking is not fast enough. So we're going to consider it, though. I think there was a letter that went out from our Division of Investment Management that went out to the investment advisor community, really asking pointed questions about the custody rule and how digital assets and the custodying of digital assets is impacted under that rule. So that letter's been published on our website, and we're waiting for comments to come in. Not comments, but public input. So if anyone has any input to those questions, please feel free to submit it to the commission staff. If you do that, if you indicate that you want it confidential, we'll hold it confidential. If not, we'll publish those comment letters.
Do you think there's not a need, but do you think that like some sort of big market event would help in the rulemaking process? Like I'm thinking of the CFTC writing rules for the over-the-counter derivatives market after the financial crisis. If that hadn't happened, I don't think I think that market would still be unregulated today. I'm not saying that there aren't like bad things happening in crypto all the time, but is that something, some big shock event or something that could maybe be necessary to go the route of rulemaking at the SEC rather than guidance and enforcement?
It's something we're constantly reevaluating, but I think that our rules as written are pretty principles-based and broad, and they've been able to cover along the years any number of kind of new financial products as they've come to market. And so our test, unlike other jurisdictions, is one that has been applied in this area, and I think applied successfully, and we've been able to draw those lines where it makes sense. But we'll continually reevaluate whether or not we need something more.
Okay. You have had a few enforcement actions. Turnkey Jet was one. It was
That's a no action letter.
Sorry, no action letter. That to me, like, I'm curious what your thoughts are on that, because it is so restrictive and just, you guys really hit everything on that one. It's got to be pegged to $1. You can't trade it in the secondary market. How is that supposed to help this market understand what is okay?
Sure, and I'm glad you brought up. We don't make up the use cases. A company comes to us with a request for a no action letter. So in this particular case, where this is essentially a tokenized jet card, it made sense for the company, because the company, it created some efficiencies where the banks aren't always open. Somebody wants to rent a jet, they have their jet card, they can do it, cuts down on transaction costs. They can keep track of who's using this. So it made sense for that company, I guess, and they came to us with a set of facts, and we said, under these facts, we don't believe that, if you were to go ahead with this and not register it, the Division of Corporation Finance won't refer you to enforcement. So it doesn't bind the commission or anyone else at the commission, but it also is a very strong letter to have. And it's only one letter. So as people have different facts, or their facts differ in some way from that, they can always come to us and ask for a letter where it's a real use case in their business.
Yeah, okay. One of the newer things is it's an IEO, an initial exchange offering. I think this could either be an exchange offering its own token, or more likely, I think it's an exchange offering another token that would be listed and traded on its venue. How do you feel about these, and how does that presence of a third party, the exchange here, complicate this or change this dynamic from an ICO, which is from the company, to an investor?
Yeah, I would say that platforms who are seeking to either list these tokens for some listing fee, or put buyers in, bring buyers to the table for the issuer, are probably engaging in what we would consider broker-dealer activity. If they're not registered, they may find themselves in trouble in the United States if they're participating in these things with U.S. investors or U.S. issuers or in the U.S. market. So I think our token lot case is instructive in this regard. This was a platform that was assisting bringing buyers to ICO sellers, and also taking ICO coins into inventory and then helping distribute them. So in that case, there was an enforcement action charging the platform with acting as an unregistered broker-dealer and also participating in unregistered distribution in violation of the registration provisions. So I would just I would hope that someone seeking to engage in this conduct would seek securities counsel. It sounds an awful lot like broker-dealer activity in the United States, and folks who are kind of doing this would probably be well advised to seek counsel.
Yeah. Another thing that I think doesn't get as much attention is the secondary market aspect of these rules, that not only do you have to be registered, you know, as a security if you meet the test, but the markets that trade them need to have an exemption or be an ATS under the SEC. Where do you stand on that? Like, is it, I don't know of anybody that I can think of that has that designation or an exemption. How should people be thinking about that in terms of when you want to go out into the secondary market and buy or sell these tokens?
Yeah, I think you pretty much articulated it well. If someone wants to undertake activity that is either broker-dealer activity or exchange activity, they need to register as a national exchange or operate as a broker-dealer pursuant to Reg ATS. We have a number of firms that I think are seeking to do that, moving their way through the process. It requires you know, a stop at FINRA as well as the SEC. But there are, you know, things to go through, disclosures that have to be made, and I think that progress is being made, and folks are looking into doing that. I do think it's instructive to look at our DAO report, because that was probably the first time, or one of the first times that we mentioned this in terms of this is activity that we regulate. And then the Division of Trading and Markets and Enforcement put out a joint statement really walking through what those implications are for these platforms. And if anyone has any questions or looking to do this kind of thing, I would urge you to contact us through FinHub, because this is the kind of thing that we could talk through. It's, you know, we recognize it's not easy. And a lot of times folks are looking to do things for the first time in an industry. So, you know, there are frictions, and we'd like to hear about them and help facilitate to the extent that we can.
All right, that seems to be it. The door is open, and
It is.
you should have people come talk to you. All right,
Thank you.
Thank you very much, Valerie.